Hi everyone, my name is Noshin Zainab and I welcome you all to KiwiTech's 808 workshop for startup and entrepreneurs to help them navigate the challenges of starting a business, making it sustainable and taking it to the next level. Today we have a mentor session on creating unfair advantages, a marketing strategy training program to securing long-term sustainable growth by Fergus Hay, CEO and founder at Edition Fields. Before we begin with our session of the day, I would like to invite Karandeep Sori, Senior Manager Strategic Partnerships QVTech, to give a quick overview of the company. Over to you, Karan.
Nosheen. Thank you so much for the introduction, Nosheen, and giving me the opportunity to present KiwiTech in front of our esteemed guest today. All right, perfect. Welcome everyone to today's 808 workshop hosted by KiwiTech. Now, just about KiwiTech. KiwiTech is just a second. Yeah, so we are a global community of innovators, or rather an ecosystem of innovators, investors, mentors, enterprises, and even corporate communities for that matter. Today, we are an organization which comprises of more than 500 portfolio companies right now, and we're currently working with them. We've Over the past more than a decade, we managed to build an investor network of more than 3,000 investors who've helped raise through which we've actually helped raise a lot of our partnering founders more than 100 million US dollars in total. Now we also have mentorship within our ecosystem. We have more than 300 mentors. Majority of them are from the investor network that we have, but we do have a lot of successful founders in their areas of expertise as well. Now, KiwiTech also steps in as a VC and invests technology development as a service in exchange for equity. And till date, we've invested more than 100 million US dollars in terms of tech services as an investment. Now, all of this really comes together through the networking events that we host like this. Now, we host around 100 events on an annual basis, which averages about 2 to 3 events on a weekly basis. And this is how we're trying to get everything together in one format. Now, if I talk about the roadmap of KiwiTech, now in 2012, the founders of KiwiTech had a pretty successful exit from the previous organization that they scaled to a 5,000 employee company, and had a pretty successful exit of 144 million US dollars in 2012, as I mentioned. Now, in 2013 is when we launched our KiwiTech startup program. Over the years, we understood the need for capital for our partnering founders. So in 2017, we launched our KiwiTech Demo Days. Till by that time, we had scaled. We had become an organization which had more than 100 plus portfolio companies. In 2019, we launched our Startup 808 series, the entrepreneurship workshop that you're attending today. We also expanded into the Middle East region. Now, in 2020 and 2021, we became and scaled to an ecosystem of more than 500 portfolio companies. As I mentioned, we host around 100 plus events on an annual basis. We even acquired a New York-based accounts and finance organization called Graphite Financial. They have roughly around 50 CPAs in the New York region. We also launched our go-to-market and crowdfunding services, and there are already 3 acquisitions in pipeline. Now, we are already on track of becoming an ecosystem of more than 1,000 companies by the year 2024, and we are targeting at least 100 companies to exit at a minimum of 100 million US dollars. Now, these are the services that we provide here. In terms of services, technology development has been our core, our bread and butter, our heritage, where we started off with. We have close to 600 engineers in-house on a payroll. We built more than 2,000 products, and as I mentioned, we have more than 500 portfolio companies right now who partner with us for technology development. Now, we also do technical due diligence for finance and accounting. As I mentioned, we acquired Graphite Financial based out of New York to help support and spearhead that division of the business. We also have events as a service where we help organize startup pitch events, workshops. We've done innovation hackathons in Qatar as well. We did one, investor summits, conferences, and we've been hosting a lot of pitch events now, as you saw, for the past almost 7 to 8 years. We also have digital marketing support, understanding the need of taking a product from an MVP stage to a commercial launch or even post-revenue stages. To support you with that, we have our own in-house marketing team to help you with the go-to-market strategies in terms of SEO, SEM, SMM, etc. We also have crowdfunding as a service, for which we partnered with WeFunder and Start Engine to just provide that extra benefit in terms of strategizing your campaigns according to these platforms or depending on the requirement of your business. So these are, in a nutshell, the services that we offer in KiwiTech. Now, all of this, as I mentioned, comes together through the plethora of or the variety of events that we host. And we try to make it very relevant for the ecosystem, in the sense for the investors and the founders, by categorizing these events as per community-specific events, hosting a lot of female founders, Black entrepreneurs, minority founders, Hispanic founder-focused events. We even do a lot of industry-specific events, region-specific, international, locally in US. And also, according to the stage of a business, so we do host a lot of family office panels, venture capital panels, or angel investor panels, depending on the ask that you're, or the size of, or the stage of the business that you're at. We've hosted a lot of other big IPs as well, Arena 24 being one of them, a 24-hour pitch event, along with the Qatar's first ever e-commerce hackathon that we hosted. Now, again, I welcome all of you to today's 808 series, the Entrepreneurship Workshop. I really thank Fergus Hayes, CEO and founder of Elysian, funds. So sorry about that, but yeah. So Elysian Fields, and I'm really glad that he's here to support and help you understand how to really devise your marketing strategy, especially to secure a long-term sustainable growth. So back to the team, and thank you so much for the opportunity to let me introduce KiwiTech to everybody. Thanks.
Thank you, Karandeep, for the overview. We have recently introduced a referral program at KiwiTech. This program rewards anyone who contributes to fruitful introductions to our company. Over the years, we have built this robust ecosystem of startups with the help of your trust and subsequent referrals. We realize it is time we give due credit to this trust through our referral program incentives. So if you know someone looking for tech development support to scale, join our referral program and follow the mentioned steps shown on your screen, or visit our website. Contribute to our growth journey and earn incentives for your trust in us. I would now like to invite Fergus Hay, CEO and founder at Elysian Fields. The screen is all yours, Fergus.
Great, thank you very, very much. I just want to check that you can see me for the moment. Can you see me, guys? Great. Well, KiwiTech, thank you so much for the introduction, and also to outlining your own great resources and capabilities. I was delighted to come across KiwiTech when I had my investor hat on, and I was at the KiwiTech Female Founders event in San Francisco last year. I found the quality of the entrepreneurs to be outstanding, and was really impressed with the organization. So delighted that we can help and contribute to the community in some way. Karandeep and I were just talking, and we wished each other a happy new year, which is obvious. And then we both realized that it's not difficult to wish you a happy new year, because last year was such a horrifically awful year for the entire world that it can only be up from here. And what better way to start than an 808 series on marketing strategy? I know you're all excited and enthralled, and believe that this is the beginning of an amazing year for us all. So with that, I will share my screen, so you won't see me anymore. And I will show you a presentation that will introduce to you the unfair advantages marketing strategy piece that we're going to go through today. I think the structure here is I'm going to share with you our thinking for the next 30 minutes or 40 minutes, and then we'll be open up for a Q&A. So people are always reluctant to voice themselves in a big community, but please do throw your questions over, and of course you can follow up afterwards. So today we want to talk to you about creating unfair advantages. And the reason why we talk about unfair advantages is that every startup is entering into a battle with less resources, less reputation, and less traction than the existing people in the category. And in order to win, you need a bit of Sparta in you. So those of you who will know the Greek mythology, these warriors of Sparta fought against the Greeks in the Battle of Thermopylae. There were 1,000 Spartans and there were 100,000 Greeks. And the reason why the Spartans managed to win that battle was because they created an unfair advantage. They found a canyon that was only 3 meters wide, and it limited the ability of their enemy to flood them with numbers. So they could only fight 10 soldiers at one time, which meant that they took away the unfair advantage of scale and resources of their competitors and enabled to win a 3-day battle. That's what the myth says. That's what the Hollywood movie says. So I believe it. But the concept of unfair advantages is exactly what founders of startup companies need, particularly in this really tough economic climate. And just a slight introduction of why we may have some credibility in talking to you about this. Elysian Fields is a boutique strategic advisory firm set up by myself and my co-founder, Martin Bailey. I was in marketing, working for the largest marketing agencies in the world in WPP and Ogilvy for 15 years in America, in Asia, in China, and in Europe. I ended up being the CEO of Ligas Delaney, which is a global marketing agency. But I'm also now on the investment committee of Rise Venture Capital, and I'm a venture partner at Blue Lion, early stage venture capital. So we have experience in building companies, deep marketing strategy experience, and we now also sit on the investor side. So we can look at investor opportunities with companies through a lens of growth and marketing strategy. My co-founder, Martin, who is a founder himself, he founded Glue, Europe's leading digital marketing agency, which he exited to Dentsu. He became the chief strategy officer at Dentsu, which is one of the world's largest marketing groups. He then went and founded Tailored, another technology startup, and he actually literally wrote the manual for the Institute of Direct Marketing and Digital Marketing for how to secure growth through digital marketing. So we put our brains together and we thought we could create a model that would help founders secure an unfair advantage in their pursuit of growth. And that's the model we're going to walk you through today. There are 4 key steps to it, which is understanding how you're viewed, defining your value propositions and your values, creating your brand differentiation, and then going to market in order to secure low cost per acquisitions and high LTVs. This model is something you should be able to walk away with and use, and it's been validated across a whole series of companies. And we have some experience. So Elysian Fields has been around for 2 years. In that time, it has had the pleasure of working with really early stage companies such as Kogo, through to now Series C companies such as Builder.ai and Soul Machines. Builder we started working with when they're just approaching their Series A. They're now looking at enterprise value of $1 billion. When we started working with them, they were kind of 50 million. So we have created the marketing pillars for these companies for them to grow. We continue to work with them, and we've often taken advisory board roles with these companies as they've scaled. OpenPay listed on the Australian stock market, and obviously Builder is securing incredible enterprise value right now. And also we have investor partners. So venture partner at Blue Lion and on the investment committee of Rise. We have close relationships with Blue Horizon, Lakestar, and Bright Eye Ventures. And we have our ecosystem partners like Kiwi Tech, and delighted to be here. But also we're a judge on the Extreme Tech Challenge program, which is the world's largest startup competition. And we've been working with Innovation Norway on the Norwegian startup community. We bring with us some big corporate experience, so we know what it's like to sell to big corporates. We've run the global marketing for Coca-Cola, Unilever, British Airways, IBM, BASF. So we have experience from businesses who are scrapping for their lives as startups, the investors who are looking at those businesses and understanding what they want to invest in, and then the big corporates who you're either selling to or considering a trade sale to in the future. So what is marketing? We believe it's persuading more customers to be willing to pay a premium for your product and to repeatedly do so over time. And those words are carefully selected. Persuasion, because you're going to be the underdog in your category. You need to persuade your customers to take a risk and choose your product or service, whether you're in B2B or B2C. Paying a premium, because in the end, you can't discount your way through life. You need to be able to have a path to profitability, which means you need to be able to justify price premiums. And in order to do that, you need to have really good value propositions. And repeatedly doing so over time. In the end, securing a client or a customer and then losing them 1 year later, which is often the case for many companies, doesn't build enterprise value, and investors don't like that. What they're looking for is, can you acquire customers? Are they willing to pay a premium? And then are they going to repeatedly purchase your product or service? And that's what we think is the core of marketing. And there are three ways as a founder that marketing can help you today, whether you are seed stage, pre-series A, or series A, B, or C. Ultimately, there are three things that marketing can do to help you. The first thing is, if you have a really well evidence defined marketing strategy, it'll make selling easier. You'll get inbound sales and you'll get media interest that will build your brand and your reputation and your awareness. Secondly, really great marketing will help you make better products because you'll have continuous customer insight into your value propositions, into your products that you can use to optimize your product development. So it actually creates enterprise value beyond just your revenue. And then thirdly, and really, really importantly, if you have a really, really well-structured and evidence-based marketing strategy, you'll be able to hit the key milestones that investors are looking for. Investors will have their KPIs, and we know them because we sit on the investment committees, that they're looking for businesses to hit. And they will be looking for evidence-based marketing and strategy. What that means is, have you done research with your customers to validate all of your assumptions? That effectively de-risks the investment and takes it away from a battle of opinion in the meeting to a battle of fact. If it's a battle of opinion, the guy with the money across the table is going to win. If you can bring evidence to the table to validate your insights, your pricing, your demand, your strategy, then it's not a battle of opinion, it's an exchangement of fact. And that will make it a much less risky investment, which will increase your chance of raising money. So marketing is really, really powerful for a founder at the stage of your businesses. And in fact, that's validated. So Manu Gupta, a good friend of ours, he's the founder of Blue Lion and was the ex-founding partner of Lakestar, which is one of Europe's largest VC funds. He said, look, we invested in Revolut because their CAC was sub $1 versus the $20 plus that their competitors such as Monzo, N26, and Chime are achieving. What he's saying here is that all of these were good businesses. They had great ideas, they had great teams. But because Revolut had done such aggressive marketing and really developed an evidence-based marketing strategy that got the CAC down so low because they created network effects and had a highly niche target audience, then it made sense to choose that one over all the others because they knew that if they put in $1, they were going to get 5x dollars back. And that's why marketing metrics were so important to raising capital. So what are the common founder challenges that we've heard? And hopefully these will resonate with you. Obviously, there are many, many different challenges we hear, but we tried to group them into the most common ones. And they land here. We're better, but buyers stick to what they already know. Or how can we stand out from the competition? Or how can we be more efficient with the marketing that we do? Or how can I deliver on our Series A promises of growth? These were the kind of common challenges that we hear from founders and the common challenges that marketing can address. Some of these may resonate with you, some of these may not be relevant, but we often find that really strongly evidence-based marketing strategy can help you address these four big topics. So regardless of the business challenge, regardless of the category you're in, regardless of the size and scale of your business, there is one commonality, which is all marketing needs to start and end with the customer. How well do you know them, your proximity to that customer, and how much evidence have you built on what their pains and their gains are that you can address? And in fact, if you look at how venture capitalists look at investing in a company, you will see that nearly half of the KPIs they look at are based around customers and validated customer insight. Here we've chosen the ladder of proof from the San Francisco-based fund NFX, Network Effects. And you will see that 50% of their evaluation criteria for a company to invest in are customer-orientated KPIs. Has it got good network effects? Does it have a good name? Has it got a high LTV and a low CAC? Can it scale its customer acquisition? Does it have good unit economics? Does it have paying customers? Being customer obsessed is really essential for your marketing. It's also really essential from an investor perspective. The more you are obsessed about your customer and the more you've evidenced what you understand about the customer with primary research, the lower risk of the investment is for the venture capitalist, which means the higher chance you have of raising money at a decent valuation. And that is more relevant in this current climate than in any climate in the last decade. So we developed, from our experience, 4 key steps to help you to winning customers and building that credibility with your investors. The first one is viewing the credibility of your product and the problem you're solving through your customers' eyes. Are you credible as an organization in front of the people you're selling to? Are people willing to take a career risk by switching from their current incumbent and switching to you as a partner or supplier? The second thing is, do you really understand the customer jobs, pains, and gains to create validated value propositions? And the key thing here is moving from intuition and existing assumption and moving into primary research, evidence-based insights and pains and gains. This is critical because it's about de-risking how you're going to sell. The third thing then is, can you create a memorable brand and personality? That is so important for a startup. You need that unfair advantage where you are notable and you can persuade people to consider you. And that's about having an emotional connection. And that's even more important in B2B than in B2C. And then fourthly, have you got a really, really sharp go-to-market system that can power your growth? Have you set up the internal tech stack? Have you got the right structure of your sales and marketing team? And then have you got continually optimized customer acquisition programs that spend your investors' money in a really efficient way to acquire customers, retain them, and create value over time? And we can share with you approaches for all 4 of these steps. Nail these 4 steps, use primary research and evidence underneath it, and you are in a really outstanding position to create an unfair advantage and to raise money from really good investors. So let's look at those steps in more detail. Step 1 is credibility. So view your own your business's credibility and product and the problem you're solving, but look at it through your customer's eyes, not through the founder's eyes. And we love our own products, but unfortunately, we're not selling to ourselves. We're selling to the more discerning and maybe less interested customer. And there's a credibility analysis tool that we've created that helps you review your business objectively. Now, when you think about your customers, if you're selling B2B, what they're really thinking is, why should I trust you with my business? And there's that famous statement, which no one gets fired for choosing IBM. And unfortunately, you do need to persuade procurers within companies to switch supplier to you, and you will be a higher risk, which means that it's a career-threatening move. So you need to build trust. You need to be seen as really credible within them. And then from a consumer perspective, if you're selling to consumer, the data from Adobe's Future of Marketing research shows that 71% of consumers spend more with brands that they trust. So it's all about building your credibility. And when we think about building credibility, we look at it in 4 ways. The first thing is insights. Have you identified the problem that your customers face? And have you identified the solution and the relevance and the value that you're creating? Now, every founder has an intuition about the problem they're solving and how their solution fits it. But the key is to move from intuition and into evidence-based, validated insights, which means primary research with your customers by segment to validate the problem, the solution you're offering, your value proposition, the relevance, and whether they perceive it as something worth paying money for. Validating those insights is a step that's often skipped, and it's often the landmine for startups. It doesn't cost much, it doesn't take long, and it's really important homework to do. The second piece of credibility is the team that is in front of the customer. Are they credible? So why are you doing this? What experience does that founding team have? And often that's split into 3 things. What is the functional experience? What is the technical experience? And then also, have they run a business before and scaled a startup before? Because a customer will look at a startup and say, I love the team, I love the product, it's fresh, it's solving a problem for me that IBM can't do, but will they be here in a year's time? And am I willing to take the personal career risk to try a new product or service from a company that I don't know? And how can I de-risk that by knowing that the team have done this before and have got resilience and proven track record? So the team is really, really important. And then traction. Can you show that your customers, that you have customers, that they're buying your products, that you're driving sales and revenue, and show visibility of your business? The visibility piece is really important. Ultimately, if you can build a backcloth to you so that when you walk into the room with your customers, you're known, which means having some PR. PR is actually a really cost-efficient way of building your reputation. When someone Googles you, can they find you in an article that talks about what you're doing and why you're doing it? The more visible you are, the more the perception of traction and perception of resilience is there. And then fourthly, your credibility as a business. What is the trajectory of your business? Is it a sustainable growth business? And I don't mean an ESG perspective. I mean, are you building on your momentum year by year? Have you got clearly defined values? And are you ESG compliant? This credibility analysis is a really good way to look at yourself and go, okay, where are we really strong? And where do we need improvement? Because that credibility is critical for a startup trying to sell to customers who will perceive you as somewhat risky. The second step is understanding your customer jobs, pains, and gains to create validated value propositions. So what that really means is understanding how customers make decisions. So we start with mapping all of the influences on a buyer's decision. So if you're in the consumer space, that's what influences consumers the most is social signaling. If I buy this brand, what does that say about me? What does that say about who I am to my nearest people around me? If I'm selling to consumers, is it saving me time? Does it signal my status? And does it show that I've achieved some sort of life stage? This is really the foundations of marketing to consumers. When you think about marketing to small to medium enterprises, SMBs or SMEs, often what really influences their buying decision is this going to improve my productivity? Is it going to save me money? Is it going to reduce my stress? And critically for SMBs, is it risky? Because SMBs often literally their house is on the line, and that's why they're often risk averse. So that is an influence on a buyer's decision. And if you're B2B2C, then the decision makers have to balance end users as well as internal business needs. You actually have two consumer bases there, or customer bases, that you need to understand the value propositions for. And then finally, for enterprises, what's really clear is that buying cohorts decide together. When you sell into a big enterprise or a medium-sized company, there isn't one buyer. There are often 6 or 7 who influence the purchase, even though you may only see one. And understanding who they are and understanding what influences them is critical to executing your sale. And that means you need to be aware of the lions and the crocodiles. In most businesses that you sell into, there will be these two types. The lions are obvious. They are visible. They're often quite noisy, and they very clearly want to grow a company or make change. These are the easiest to spot and the easiest to work with. Sometimes you get mauled by a lion, but they're very visible and they're pretty transparent. They're often people with a change or a growth agenda inside a company. It's the crocodiles you have to watch out for. The crocodiles you can't see. They hide under the water with their eyes just peering above. And you only notice them when you step into their territory and they snap. And they snap at you because you're a threat to their territorial domain. And these are the ones that often stop the B2B sales experience. You often hear from founders, we don't understand, we have a great meeting, we're dealing with a lion, and they've really got a strong agenda, and then it hits an invisible wall. And that invisible wall is because there's 5 or 6 people who are also influencing that B2B service or product purchase. Someone is being threatened. And it's really important to understand who are the crocodiles, what are they threatened by, so that you can develop a value proposition that takes away that threat, neutralizes it, or preferably turns them into a quiet lion. So look for the lions and the crocodiles, as they will be secret to selling into corporations. What that really means is mapping who is buying, influencing the purchase inside the company you're talking to. This is an example from one of our clients in the property space, where there are so many different people influencing the purchasing decision. Each category will be slightly different here, but if you haven't mapped out the buyers of your product or service, you won't know what the value propositions need to be for each person, and you won't know where the lions and the crocodiles are, which means that you will find yourself having lots of hot leads that don't convert. So really understanding the customer mapping and understanding the insights into each one of those people will help you improve your conversion rates. And when you've understood who the buyers are, you can then map journeys. You can create segments out of those buyers and map journeys to convert them. Again, this is systematic, it's quite engineering orientated, but it really helps you understand the motivations and the potential barriers to closing a deal. And so if you can map the buyers and then you can understand their journeys, you can drive conversion. And this is an example from one of our customers, Get Transfer, which is the world's largest airport mobility business, transfer business, about how we broke out the different buying journeys for the different customers. And ultimately, you bring that together in this critical template. This is the template that will power your marketing. This is your value proposition template. This is an example from one of our customers, Soul Machines, where we were selling into the insurance market. On the left-hand side, you will see a description of the person who's buying it. This is the persona. This is outlining what their KPIs are, their job description, and what their motivations are. In the middle, what you will see is a breakdown of the pains that they're facing and the gains they need they're looking for. And we're mapping the product benefits against each one. So in the middle, we've got the pains we're avoiding, and then beneath that, you've got what are our product features that relieve that pain. On the right, we see the gains that customer is seeking, and underneath it, we've got the gain creators. What are the features of our products and services that enable them to achieve those gains? This is based on customer interviews. So at early stage businesses, so pre-Series A, we really recommend you, once you've defined your segmentation, go and do qualitative research, 45-minute interviews with 10 people in each segment of your target customers, so that you can understand their pains and their gains. What are their barriers? What are their KPIs? What is it required to persuade them to switch from their existing supplier to you? Those 10 interviews that you do per segment are, of course, not statistically valid, but they are evidence points that you can present to potential investors to say, this isn't based on my opinion of what our product and how our product helps people. This is based on primary research from key customers that have given us qualitative insights into the pains that we're relieving and the gains that we're achieving. And that enables an investor to go, okay, these guys have done their homework. It's a de-risk marketing strategy, and they've really zeroed in on what the value proposition is. And the value proposition is what you see on the right-hand side, which is our product helps these people who want to achieve this by offering X and Y instead of Z. You ultimately developing value proposition templates like this per segment for each buyer that you're selling to will enable you to improve your accuracy of messaging, get to message market fit, have evidence-based insights and value propositions, and enable you to market to the right people with the right message, ensuring that there's no wastage in improving your customer acquisition scores. And that is what takes you to continuous validation. So as we said, in stage one, you uncover the jobs, the pains, and the gains. That's a qualitative research. Once you've developed the value propositions, you create draft test messaging. You then qualitatively test that messaging back with the same people so that you get feedback to make sure you have message market fit. And then you start going and testing language with paid media doing A/B tests. This value proposition validation cycle should be continuous. You should think of yourselves in every stage of your business as continuously going back to your customer to do test, insight, test, learn, optimize the insight, and continually do that. The more you do that, the more you have an evidence base to increase the accuracy of your messaging, which will increase your rate of sale, which will decrease your CAC and increase your LTV. And this is what investors love to see, evidence-based, primary research orientated approaches to your marketing. And like I said, it can be 10 people per segment. You could only have 4 segments. You're only interviewing 40 people. You can do it quickly and it doesn't cost a lot of money, but it's very, very powerful. So step 3 is then creating a memorable brand and personality. How do you stand out, be notable, be respected, and build your reputation? And this is the common substance of brand strategy. This model is being tested by thousands of companies over the years, and it's about finding your unique point of view. And for us, that comes down to being accurate about what's true. So first of all, start with what's true about your product. What is it that your product actually does, and what problem does it solve that is different to other people? And then you look at what's true about your customer and how they interact with the category. What is the insight into how they feel? When you start to map your product features to the insight, you start to get your own space. And then underneath that, you look for what is the environment that your customer is operating in. So if you're selling to the consumers, what's the cultural trend that is affecting them and how can you benefit? And if we're selling into businesses, what is the business and technology trends that you could benefit from? That intersection of what's true about your product, what's true about your customer, and what's true about the cultural trend that is affecting the category will be your unique point of view. And that point of view is really important, because if you only ever talk about your product feature and your price, you will stay as a commodity. You ultimately have to have a point of view on the category and what you're doing to make it, to improve it and make it better. When you have that unique point of view, you elevate yourself out of the street fight. It enables you to have a PR program that gets you featured as commentators in key media, which again builds your credibility, builds your differentiation, and builds your distinction. And it's really important to elevate yourself in the street fight out of the commodity services that you'll be competing with. And of course, a core part of that is developing your mission and personality. This is Simon Sinek's model, or I'm not even sure it's his, but he popularized it, which is defining why are you in business, how do you do it, and what is it that you contribute. You'll see this model many times. It's a sensible model to use and to fill out, and it gives you a core anchor point to your company's mission and then the tone of voice and personality of your brand. What I would say is that unlike big corporates, a startup, the brand is really an extension of the founders. It tends to be a real extension of their personality. And I think that's okay. I think it gives you authenticity at early stage companies, and you should be okay with that. And the reason why the brand is important, and obviously B2C, people get it, the brands are important, but actually brands are so important in B2B. And they're important because really good brands build emotional relationships. And that delivers profit over time. This is a data set from The Long and the Short of It, which is a seminal marketing study done by Binet and Fields. I think they've evaluated something like 10,000 data points from brands in both categories, consumer and B2B, to understand what is the impact of those brands that have built an emotional relationship with their consumers. So what you see here is tenure of marketing, so 1 to 2 years or 3+ years. And those brands are purely rational, those brands that are purely emotional, and those brands that are both rational and emotional. And the size of the bars, the percentages, are how much profit growth is reported. So in the first 1 to 2 years, you can see that actually the rational brands report the least growth in profit. The purely emotional brands come in at 21%. But when you combine the rational functional benefits of your products plus an emotional positioning of the brand, you get to a 27% profit growth rate. And then when you extrapolate that over 3+ years, you really see that those emotional brands really drive long-term profits. That's because ultimately, when people have an emotional relationship with a product or a service, that makes it very hard for them to switch. And that's your defensibility. So often what we'll hear, particularly in the B2B space, is people say, well, as B2B, we can just talk about our functions and why we're better and our price. But actually, B2B is really important to own some emotional space because it'll differentiate you from your competitors. And over time, it will deliver you more loyalty and more profit. So once you've gone through those 4 steps, you can capture your strategy on 1 page. And that's for everyone in your company to use. This should be owned by the founders, and it should be used as a framework and a set of handcuffs, really, for all of your employees. Often what we see is that as companies grow, they hire great talent who come in from either other startups or come in from big corporates. And that's exciting, but it's also highly risky. Because what happens is everyone imports their experience and imports their cultural experience. And often people want to throw out all the work that's been done and reinvent everything. You want obviously you want optimization, but what we see is people continuously reinvent the wheel, and it actually damages the company and really slows down revenue growth. So having your strategy that, remember, is based on primary research, is evidence-based, and is continually optimized, framed on 1 page, to show people that the thinking's been done, it doesn't need to be reinvented, and that to have people to work within that framework will really, really reduce inefficiencies within your organization. So this is the framework that outlines your strategy on a page. And we've given you an example for Calendly. And in this case, we've identified what the current situation is. The current situation is, when you're talking to a customer, is scheduling meetings takes time. The desired outcome that people want is not to have to think about calendar organization. The current workaround is people get lost in emails, they hire a PA, they use their phone, or they use clunky apps that don't sync well. And what interferes with that is people have too many calendar accounts, they have overloaded emails, they're stressed, and they have very busy days. And when the organization drops, businesses slow down and become really inefficient. And the impact economically and personally on that is meetings don't happen, time is wasted, money is wasted, and also reputations are damaged because people are seen as inefficient and chaotic. I'm sure every single person can identify with this. The desired situation that Calendly want to move their people to is creating a new approach. So add and receive meetings in a calendar in seconds. That's perfect for contractors, self-employed, and micro business managers. The new thing that they bring in is brutal simplicity of design and implementation. That's what they're doing to solve the problem. What the reward for the buyer is, they never have to think about meeting organization again. So the transformation we sell is we go from wasted time and effort to increased productivity, which means that we have a value proposition. Our simple meeting booking tool helps busy contractors, self-employed, and micro business managers who want their time booked by removing wasted time and back and forth hassle and increasing the productivity of their day, unlike struggling to manage your own diary or hiring someone to do it. This is what Calendly's value proposition is. And how you put that into a brand provocative point of view is winners don't organize their own meeting. That's the bit that gets people noticed because it's got a bit of attitude and a bit of personality about it. And then you have the elevator pitch. If I was selling it to someone quickly, Calendly is the simplest way to book meetings and manage your calendar, saving our smart customers hours every month by removing hassle and headspace so they can be more productive and successful. So that is an example of a strategy on a page that's owned by the founders. And of course, you have the freedom to improve it and change it. But what you don't want is new people to come into the company and dismiss everything and create their own versions, which then creates a Frankenstein version of your marketing and your brand, which ultimately will damage your revenue growth, which ultimately will damage your ability to continue to raise money. And then finally, once you've done the strategy, it's about going to market. How do you spend your investors' money in a really efficient way to drive customer acquisition? And there are three phases of go-to-market maturity. For seed stages, it's about message market fit, seeking market validation of your core idea and going to test your hypothesis with your customers. For Series A to B businesses, it's more like product market fit. You want to seek repeatable customers, which means taking your segments and channels and scaling them. And then once you've got to Series B plus, you're looking at platform market fit. How do you get predictable revenue from multiple products? And that's about account-based marketing and go-to-marketing systems. The foundations under all of these pieces are personas, value propositions, and brand and growth strategy, which we've just walked you through. And that means you need to build a go-to-marketing machine. This is obviously an investment from all businesses, but you need to treat go-to-market as a product with teams contributing equally to its success. So retention data guides acquisition targeting, successful customer profiling powers lookalike modeling. You have a new team of revenue ops that provides the insights and the direction. And then customer service success work with marketing and sales to acquire and develop the right customers based on LTV data. It's a circular program that continually using insight and validation to inform marketing, sales, and customer success so that you're continually getting the organizational growth and scale that the company requires. And then that always raises the question of how should I split the spend of my marketing budget? This is actually IPA data, Institute Practitioner of Advertisers data, that applies to both B2B and B2C, and it makes every founder uncomfortable. But ultimately, how you should split your budget should be that 54% of your budget should go on lead generation funnels for each segment or business unit. But 46% of your budget, including PR, should go to brand building. That's a fixed cost because it needs consistent annual spend. And that's that builds your emotional attachment, your long-term loyalty, and your profit over time. And 54% of your budget is about converting that feeling into sales. It's a really uncomfortable chart. Every founder hates it, but it is validated by the marketing data to show that the money spent on building the brand and the emotion drives a more efficient funnel and more long-term profit. So that's it in sum. The 4 steps of the unfair advantage method. Step 1, look at your business from a credibility perspective and think about how your buyer of your product or service views you. You can also insert your investor views you. Step 2, do primary research to identify the pains and the gains inside each of your target audience so you can develop value propositions that are validated and optimized. Step 3, build your brand story, your differentiation, your emotional attachment that will deliver you more profit over time and reduce your customer acquisition costs and improve your LTV over time. And then step 4, go to market. Put that investor money really efficiently to market, create the revenue ops model so that you're continually optimizing and you're improving your CACs and LTV ratios on a weekly basis. These are the 4 steps. that are underpinned by primary research that will create that unfair advantage and enables you to be a de-risked investment opportunity for investment committees. And these are the critical weapons that help you secure that unfair advantage. Remember that marketing is critical to reaching fundraising milestones. You know, investors are looking for you to crack milestones, beat them, and have really efficient marketing programs. In order to do that, you need to be customer obsessed. Validate, validate, validate. Every time you're relying on a personal assumption, your risk profile goes through the roof. So always go back to the primary research. Step 3 is be methodical. Use discovery, use research, validate your value props, differentiate yourself, validate again, and then go to market and optimize. That engineering mindset, which you've used to create your product, should be deployed on your marketing. And then look for that emotional differentiation, because you know your competitors won't, and that's how you'll stand out. Follow that process and use the tools, and then execute ruthlessly. So in closing, I hope that's been useful. It's been a very top line whistle-stop tour through the 4 steps to create your unfair advantage. What we're really happy to offer the Kiwi Tech community is every member, anyone who's on this call, we're happy to offer you an unfair advantage diagnostic session with partners from Elysium Fields to talk through your business and identify how much of this have you nailed and how much of it is open, and to help you get a plan together so you can get a really efficient marketing program with really strong evidence-based strategy, and then become a de-risked investment opportunity for your next investment round. If you're interested, my contact details are here. We'll circulate decks, and we hope you have found this useful. So with that, I will open up to questions.
Thank you, Fergus. That was a great presentation. So we have a question. When reflecting on the startups you have worked with, what would you say are the top 3 mistakes companies leaders make when it comes to approaching marketing their business?
Great question. Off the top of my head, I would say the first thing is relying on intuition and assumption and not evidence-based. So often founders have a really good feeling for the customers they've spoken to, and they translate that into value propositions. But that's really, really high risk. And they have to go back and research it with primary research. By the way, it's so affordable to do it. Every business can afford it. You know, we're talking very, very little amounts of money to de-risk it. So number 1, move from intuition and assumption to evidence-based. Number 2 is believing that because you built a brilliant product, people are going to use it, and getting frustrated when customers don't. What we often hear is, in a bake-off versus IBM or insert incumbent here, we always win. The problem is you need to persuade people and build credibility. And so just being better in a features and products isn't enough. You need to look beyond that. And then the third thing is often founders are in hand-to-hand combat. They're doing the sales themselves. They're speaking to the customers. And that builds proximity, which is really, really great, but it doesn't give perspective. And perspective is really, really important. And the problem with hand-to-hand combat is that in a company's life cycle, your first sales are not a proxy for how you're going to scale your company. Your first sales are often to either people you know, and so they're giving you a chance, or they're to early adopters, innovators. And the classic thing that founders come up against is they go, wow, our rate of sale is X in our first $1 million worth of revenue. And so then they extrapolate that in a straight line. But the problem is you hit that chasm, very famous book, Crossing the Chasm, where you have to move from the risk-taking early adopters to the mass market in your category. And switching over to that mass market needs often different value propositions, different product pricing, and different go-to-markets. And that identifying when you're approaching that chasm is absolutely critical for a founder. The earlier you see the chasm coming and realizing you're about to move beyond the early adopters, that's when you really need to go back to all the homework and make sure that you're not basing it on previous experience, not basing your growth on previous experience, but really doing the homework on understanding the insights to the customers who are going to scale your business. So go from intuition to evidence, get out of, spot the chasm before you go into it, and And I've forgotten what the second one I said, but someone else will remember it. Does that help? Is there a follow-up question to that?
No, there is no follow-up
Okay.
question. We do have another question. Can we talk more about a GTM organization?
So Crystal, thanks for the question. I guess if you can follow it up very quickly in the text, that would be great. If not, then I'm just going to take a punt here. I think you probably mean like, what does the go-to-market structure look like for my company? And the answer to that is it depends on where you are in your organizational growth. So are you a small company where you're testing message market fit and you've got 20 customers? The structure of your team will be different based on someone who's got $1 million of annual revenue, 5 million of annual revenue, etc. So you need to build your go-to-market in steps to mirror your rate of growth. And what go-to-market looks like for a company that's doing Series C is very different to what it looks like for a company's Series A. What I'd suggest is, there's the follow-up, because that saves me from floundering. Let's say our customers are from various other companies. How do we manage that? So that is, I think what I understand from you saying there is that you have multiple customers from different companies. So how do we go to market? That's a segmentation, Crystal. So, you would hope to not have more than 4 or 5 different segments, types of customers that may fit, that have different profiles. And that profile might be categories they're in, or size of companies, or problems that you're solving. The key is, in our opinion, you should start niche, really focus on the niche segment that you can convert, because that will build your traction. And it's absolutely fine to build your business in niches. And in fact, that's how Revolut did it. They targeted customers who traveled a lot and who wanted really great Forex exchange, even though their plan was to be a bank. So identifying your niche, building your credibility within that niche, and then moving into the adjacency niches over time is a really sensible way of building your traction and credibility.
All right. There is one more question. At what stage should I be building primary data sets? Isn't it really expensive? So
great question. You should be doing it from the minute you think you're going to set up a business. And no, the way the market presents primary research is really expensive, but Elysian Fields have done it in a way so that really early stage seed companies can, if you were recruiting, and Noah, my colleague, is on the line, he could probably clarify this, but if you wanted to do 50 or 60 interviews and qualitative interviews, 45 minutes, run by someone from Elysian Fields, you're talking about less than $10,000. So we believe that it's absolutely critical to the company, and that's why we found pricing to make it really, really efficient. So I would say, and I'll give you an example. We worked with a brilliant set of founders who had IPO'd their last business, and they had a concept for loan provisions to SMBs, and we worked with them at white paper stage. So they had no company, but they were working through it, and they brought us in. And we interviewed, I think, about 200 SMBs. I think it cost them $20,000. And it was the best $20,000 spent, because what we found out was the insights into these companies and their needs were not the product that these guys were going to build. And based on that, they actually canned that startup and went in it on a different startup. So investing in qualitative research to identify insights, to really understand whether there's a problem that people are willing to pay for, stopped those people raising millions of money and wasting it. So it could not be more important. It can be done really cost efficiently, and it is effectively, you are de-risking your business. So I couldn't recommend it more.
Thank you, Fergus, for the great presentation and all the Q&As. With that, I would like to thank our mentor and guests for joining us today, and we'll be back soon with more workshops.
And contact us if you would like your diagnostic session. My email's there. We're very, very happy to sit and chat to people and see where they are.
All right. And also, apart from the workshop, we have more upcoming events. You can check out our website and the screen. Do join us, and we would love to host you on those events as well. Thank you and have a great day ahead.